What's going on? Welcome back to Fibonacci Journey. So today I wanted to share with you a webinar. A lot of people are always curious on how to do technical analysis. So I wanted to kind of share this with you. It is part of the 𝗖𝗢𝗡𝗡𝗘𝗖𝗧 premium package. So a lot of people might not necessarily have access to this. And I listened to it and it's very well kind of laid out. So I think a lot of people might get some good benefit out of this. So I'm going to play this. You guys can do what you will and obviously pause it throughout the video for multiple stages. But don't forget to hit that thumbs up and subscribe. If you do want further videos such as webinar and kind of teaching you on how to kind of be a better investor in general, let me know your thoughts. I can always try and find different webinars. This is exactly why I do have multiple different portfolios, different brokers, because each one kind of has their own set of kind of tools that they want to kind of share with potential individuals as well. So don't forget to hit that thumbs up. And with that, appreciate all of you guys watching.
Hello, everyone. I'm Daniel 𝗖𝗎𝗪. Thank you so much for taking the time to join me today. We are joined by the one, the only Mr. Avi Gilbert. As you see him popping on with us right here, we're going to dive into all sorts of information around Elliott Wave, where he sees coming, what's going on with the Fed, what sectors, indices, everything today during this time together. So thank you for tuning in. But before we jump in, I want to go ahead and get one quick thing out of the way, and that is our legal disclaimer. So stick with me for 1 second. As you can see it pop here on the screen, past performance is no guarantee of future results. Any views or opinions expressed in the webinar do not reflect those of Seeking Alpha as a whole. Seeking Alpha does not take account of your objectives or your financial situation and does not offer any personalized investment advice. Seeking Alpha is not a licensed security dealer, broker, U.S. investment advisor, or investment bank. Information provided by the investing group does not constitute investing advice. Investing group leaders are third-party authors that include both professional investors and individual investors who may not be licensed or certified by any institute or regulatory body. Any content and tools on the platform are offered for information purposes only. Now, with that out of the way, many of you may know who Avi is. He has been running his investing group service for 13 years now. Congratulations, Avi, by the way. That's a huge milestone.
Thank you.
The community you have built is tremendous. It's rippled everywhere. I mean, I think everybody knows who you are just personally. But for the people that are here today joining us who may not know who you are or how you got started, maybe you could just take a little bit of time here at the top and we could talk about how the man, the myth, the legend got into investing.
Well, it actually isn't the best of stories. A number of years ago, I had remarried, and my wife, I had a very, very successful consulting business at that time. I was doing a lot of tax consulting and M&A, and my wife at the time, we found out 11 days after she had our son, our youngest child, that she contracted a very rare and serious form of cancer. So I had been spending we were months at a time in the hospital, and I started day trading out of her hospital room. And I joined another market veteran named 𝗪𝗧𝗪, who's been in the industry for God knows how many decades now. I joined his site. And he started, he would be identifying those stocks that would gap up, and we would trade those stocks during the day. So after a while, I started feeling a little more comfortable in the site after I got to know the people in the site a little bit. And I started utilizing my analysis methodology to make market calls or stock calls. Sometimes I disagreed with Harry. Sometimes I agreed. We got into a discussion. And after a while, I started developing a following in his website. So Harry reached out to me and asked me what I was doing. So I said, well, I'm doing a modified form of Elliott Wave analysis where I have a very tight objective box around the Elliott Wave analysis that we do. And, he started following me a little longer, and he said, eventually he called me up and he said, you really have to teach what you do. So he tried to set me up with his partner who set him up to build the website. And I said to him, Harry, I've got an infant, I got 3 teenage children, and I've got a wife who is quite ill. I had to quit my consulting business at the time because I had no time to work. And ultimately, I I was basically, like I said, just day trading out of his room out of her hospital room at the time. And I said to him, I just don't have the time to start anything right now. So after maybe about another 6 to 9 months passed, and we started seeing some light at the end of the tunnel with my wife. So she knew how much I love the investing business, how much I love trading, and so on and so forth. So she started pushing me to say, maybe you take him up on this. It may, it's something you love, so why not do it? So after a while, she pushed, and I eventually took Harry up on his offer, and we opened up Elliott Wave Trader. Literally, we had our 13th anniversary yesterday. And unfortunately, my wife passed away about 6 months, I'm sorry, about a year and 3 months after we opened, a year and 1 month after we opened the site. It was October, so a year and 1 month after the site. But that's how I got into this. I was kind of pushed into this by Harry Boxer many years ago.
Yeah, and out of the ashes came the phoenix, right? I mean, it's an incredible story, and I think it's unique to you specifically, and we all have our own stories. But you mentioned Elliott Wave. You got into this theory and this process, and how did you learn it, and how did you start implementing it and teaching other people about it?
Well, I have an economics and accounting background as well as a law background. I really understood, and I did a lot of M&A work, and I really understood how to take apart balance sheets. So I knew how businesses run. Taking apart a balance sheet was never an issue. That's how I identified some very large transactions that I would put together that had some really good value. But after a while, it's one thing to do it with a business. It's another thing to do it investing in a stock. And the stocks didn't always run with what you would expect from the internal fundamentals of the business. And, one time after another, it just got very frustrating to see the fundamentals are not aligning with the stock price. So it led me to think there must be something else to this. And I went on a multi-year journey going from one thing to another, trying to figure out what is that missing link. Ultimately, I ran across some of Robert Prechter's work, and it was discussing more of the market in the way of sentiment. That sentiment was a bigger driver in stocks than the actual fundamentals. And I started delving into it, and it was the first thing that ever made sense to me outside of, and look, the efficient market hypothesis never made sense to me, even when I was learning it in college. But it was the first thing that made sense to me that, sentiment could be a driver here. And the further I went down that rabbit hole, the more and more sense it made to me. And that's how I got into Elliott Wave. It was the only thing that really made sense to me that was consistent through all various cycles.
Yeah, so you're talking about Elliott Wave, and for the people that may not know what it is, it's kind of like a roadmap, right? It kind of gives you a little sense of direction, and you have optionality, and you kind of, like you're saying, take the sentiment of stock prices, which can sometimes feel disconnected from the fundamentals, like you just mentioned. So maybe if we could dig a little bit deeper into Elliott Wave, because we might have some people here with us that don't understand the 5 waves, the ABCs, things like that. Would you be able to give a little bit of a insight of a visualization of what that might look like?
Well, yeah, many years ago, back in the 1930s, a gentleman named Ralph Nelson Elliott identified that the market or individual stocks really move based upon a fractal pattern. And that fractal pattern is a 5-wave structure. Waves 1, 3, and 5 move within the direction of the trend, whereas waves 2 and 4 move counter trend in a corrective sort of move. So, and then he tied that to Fibonacci mathematics as to the extent to which a wave can travel. And he also explained that when he said markets are fractal in nature, it means they're self-similar at all different degrees of trend. They're variably self-similar, not exactly self-similar, but they're variably self-similar at all different degrees of trend. So when you look at waves 1, 3, and 5, you can break those down into 5-wave structures themselves. So wave 1 will be a 5-wave structure, wave 3 will be a 5-wave structure, and so will wave 5. Whereas the corrective structures take 3 waves to develop. So that's the general Elliott Wave model.
So you're using this Elliott Wave model, though. You're using it across all these indices and commodities and different types of stocks, right? So when you're looking at the stock market from this perspective, does all of this macro data and this federal interest rate cut and all of these variables that we're always hearing about in the media right now, do those also get factored into this?
The answer is I don't really bother with any of the exogenous events that go on other than knowing when they occur. Knowing when they occur is important because oftentimes they can act as a catalyst for a market move. But the substance of that of the market, the substance of the event or the news item really does not give you an appropriate view as to direction. The best example I can give was most recent example was back in 2022 when the market was dropping. It was dropping that whole year, and in October, middle of October, we were dropping into the 3,500 region. And I remember everybody was hyper focused on, I think it was an October 13th CPI report. And everybody was so certain that if that CPI report came in much more negative than they expected, market's going to drop another 5%. I was looking at the chart, and the chart told me sentiment was at a bottom. And I said, I'm looking out into November timeframe and beyond, and we are going to be much higher than where we are right now. Our bottoming target was about 3,500. I think we dropped maybe a few points beyond 3,500 when the report came out. The report came out much more negative than everybody expected. But the market actually rallied 6% on that day off that intraday low. It did the exact opposite of what everybody expected. It's because the market report acted as a catalyst. The substance really didn't matter, but the report was able to act as a catalyst. And that's why I like to know when a major catalyst is occurring, the substance of it really doesn't bother me.
So that's a really great point, because I think if everybody here watching with us live or you're watching the replay remembers just last week when we had the Fed cut rates for the first time of this cycle, and the reaction day of was more muted, but the day following was a nice explosion to the upside. So does that kind of factor in with the timing aspect of how Elliott wave theory also works?
Well, you almost have to put on blinders when you look at that Fed day the other day, because the market spiked up. Then the S&P actually wound up negative on the day. So how do you explain, what the real reaction was to the Fed, or really did it matter? Did it really matter at the end of the day? The market was setting up even before then to go much higher. It was actually on 9/11, which was days before the Fed came out, that the market told us that it probably was going to be heading much higher than the recent high we struck. So it was on 9/11 we saw that the market was going to set up to go higher. The Fed really just played into what the market was setting up to do already.
Yeah, that's amazing. So maybe we can start talking about where we are in the cycle, right? Where are we in this Elliott wave, 5-wave, 3-wave, things like that? Because I think that's what everybody here is joining, really wanting to hear from you about, right? The SPX, or if we're talking, commodities. I know you've been following silver, and for anybody that was at the Seeking Alpha Investing Summit back in June, that was something you highlighted then, and silver has just had a nice little run this year, specifically just to highlight one of your wins. So if you don't mind, maybe we can start diving in a little bit deeper into the different markets.
Sure. On the S&P 500, when you look at a 5-wave structure, we spoke about how Elliott told us that the market is fractal in nature, self-similar or variably self-similar at all different degrees. So the question really comes down to, what wave degree are we dealing with? Well, if you take a step back and you look at a 100+ year chart of the S&P 500, we are actually coming to the conclusion of a final 5th wave in a multi-decade 3rd wave. Elliott himself, back in 1942, outlined that he was expecting what he actually called for a multi-decade bull market. Now, what was going on in 1942? World War II. So during the heart of World War II, Elliott made a bold call in saying, we're about to enter a 70+ year bull market. Now, in my opinion, that is the best market call of all time, bar none. You're in the middle of World War II and you're calling for a 70-year bull market. Well, we're now coming to the tail end of that bull market that Elliott called back in 1942. And it actually began at the bottom of the 1929 market crash, which I believe bottomed out in 1932. That was a large degree wave two. Since that time, we are now completing a large 5-wave structure off that 1932 low, and we are completing a 3rd wave structure off that 1932 bottom. So my opinion is we have one more rally. And years ago, I made a call that my expectation before this bull market ends will likely take us to 5,350 to 6,000. And I think I made that call somewhere when we were around the 2000s. And we are now coming into that target zone. We're in that target zone. The way the market is structured right now, we could slightly exceed my long-term target of 6,000. Call it a blow off top, call it whatever you want, but the market is now structured, if we continue in what we're seeing, probably about 6,150 to about 6,200, somewhere around there is where we're targeting at this time. We're going to keep tracking this, but the question is, when you look at the bigger trend, are you picking up pennies before a steamroller? That's really the question. Yeah, we can trade for a couple hundred points higher, but I think people should start looking at raising cash and considering that we could be seeing a very long-term bear market coming just around the corner.
Now, the interesting thing is when you mention that to all of us right now, is I'm thinking all about the worries of recession. Right, recession in the economy, or the consumers feeling stretched on credit card spending and things like that. Is there any thesis and catalyst to that approach, or is it just, hey, we're waiting to see the market top out around the 6,000 level, and then we'll redesign the waves on the contraction from there?
Well, I look at economics as something that is more ivory tower than anything else. From somebody who I learned economics, I practiced economics. If you even read 𝗖𝗎, came out in 2010 and said he no longer uses the efficient market hypothesis because he doesn't believe it works. So if you have the father of the efficient market hypothesis coming out and telling us that these economic theories really don't work in actual practice, I abandoned it a long time ago, a very long time ago. So if we want to take economics, that's a theory. It's a nice theory. I can't apply it in the real world. Mandelbrot came out and said, now that we have the fractal pattern structures, we have to look at that from a finance perspective rather than the economic perspective. So, as we develop, we look for points and structures that confirm our analysis as to whether or not the market's going to go higher or lower. So once we finish off this next 5-wave structure that we're tracking right now, we're going to see how the market develops off of that. So as far as when am I going to get a confirmation, I look at this as I believe this next bear market's going to take us at least 13 years, could be as long as 21 years. So if I'm looking at a very long-term bear market, I'm going to be seeking some very strong confirmation patterns in play. So after we strike the top, it may take us a number of months before we get that final confirmation. So that's really how I'm looking at it from a fractal standpoint, not an economic standpoint. People will make a determination as to whether we're in a recession after the fact. The best example I can give was back in 2019. At the end of 2019, I was calling for a 30% decline in the market. Now, it didn't start, and I said I think it could probably begin in the first quarter of 2020. I didn't expect it all to complete in the first quarter of 2020, but as we now know, and I said this before anybody even heard the word COVID, as we now know, we had the COVID crash and took off 30% from the market. But what was interesting was the economist did not come out and call it a recession until the market had already rallied over 1,000 points off the low when that crash completed. So economics, unfortunately, is a very, very lagged perspective, especially when you're dealing with fundamentals. It's a very lagged perspective. So I like looking at waves in real time to tell me what the economists are going to tell me a few months later.
Yeah. So to sum it up, don't trust the economists.
Pretty much.
I want to ask you a question about the timing aspect, but there was a great question that just came in here in the chat. Since we've been talking about the bear market that potentially might be coming, 𝗖𝗧𝗧𝗧 says, which strategy would you prefer for the bears market? Do you have specific strategies that you kind of mirror in with this Elliott wave theory that you like to use?
The answer is primarily I tell our clients to go to cash right before we expect a large decline to take place. Now, because the 1929 crash to 1932 was a straight line down, Elliott tells us that there's a theory of alternation where if the second wave is a straight line down, the fourth wave is going to be a very long, very prolonged up, down, up, down, up, down series of waves. So you're going to have multiple opportunities to go to cash and then to go back into market for a multi-year rally. So the way I explain it to my clients is, at the highs, raise cash. When we get down to the bottoming structures, we're looking for the first decline. You can go back into the market for a multi-year rally and so on and so forth. And you're just going to rinse and repeat this. The bigger problem comes into where do you put that cash? And this is something we have discussed ad nauseum. And years ago, when I started explaining to our clients that, I think it was around 2016, 17, I started saying to them, okay, within the next 10 years, we're going to have storm clouds forming. And it's probably when we get to that 6,000 region target, storm clouds will likely be forming. And I'm going to want to start discussing what do we do when the storm actually hits. One of the suggestions I had is take your cash, put it into a safe bank. So they started asking me, well, what's a safe bank? So I started looking at a lot of the bank charts. And a lot of the large bank charts really got me concerned, especially some big ones like Citibank, Capital One. They look like they potentially would not make it through a major financial crisis at this point in time, based upon the structure of their charts. So I hired a fundamental analyst, and we started a banking analyst actually, and we started picking apart their books. We started picking apart their fundamentals, and we started identifying that a lot of these banks have 5 major issues that are sitting on their balance sheets. And because of these issues, there is a good chance a lot of these banks may not make it through a prolonged financial crisis. I know Janet Yellen said back in 2016, we won't have another financial crisis in our lifetime. I thought maybe she was older and didn't think she'd live more than a few more years. But for the most of us, I think we probably will be seeing another major financial crisis in our lifetime based upon the way the balance sheets of these banks look. So we started looking at, well, let's try and find some safe banks. So we actually opened up a service it took us a year and a half. There are about 5,000 banks in the country, and it took us about a year and a half of research to find just the top 15 banks. It took us a long time. And we rolled out another service called saferbankingresearch.com, and where we're identifying some of the safest banks we find all across the world. So, we're trying to suggest to people, go to cash. If you're aggressive, you could try to do some shorting during the bear phases, but go to cash, make sure it's in a safe place during the bear phases, and then you can use that cash and put it back in the market when we're going to get those multi-year corrective rallies. Now, when I say a multi-year corrective rally, the best example I can give people is look at what happened from 2000 to 2009. Whereas the market, for the most part, went sideways. From 2000 to 2003, you had a sizable 3-year decline. From 2003 to 2007, you had a 4-year rally, a bull market, a bull trend. But that bull trend was within a larger corrective rally, because then in 2007, we had that large crash. That was an ABC structure for a smaller degree fourth wave. We're going to see a lot of those types of structures during this bear market. So you'll have an opportunity to get out of the market near the 2007 highs. You're not going to get the exact high, but as we approach the 5-wave structure high, it's a great time to go to cash. As you get to the lower end of the first leg down. You could put your money back in, like at the bottom of 2003, ride it out for a few years. As we start seeing the topping signals for that rally, go back to cash, let the crash happen, and then you just rinse and repeat. But that's going to have to be how most people will be playing through this bear market. And unfortunately, just like in the Great Depression, you had over 30% of banks that went under during that time frame. I fear that we may even exceed the percentages of banks that go out of business during this next financial crisis that I expect.
That's quite an expectation. And there's a lot of questions coming in as you're talking about going to cash, right? And all these questions are coming in saying, why not go to gold? Why not go to Bitcoin, which some think is digital gold? Why not go to silver? Why not go to the metals? And why stay in cash and put it into safe banks?
Well, because most people, there are so many fallacies that go through the market, and people just assume that it's correct because so many people say it's got to be correct. For example, gold is a safe haven during financially troubled times. Everybody believes go to gold if the market's having a problem. It's a wonderful belief. It just ain't true. If you go back and look at the 2008, 2009 financial crisis, you literally will see gold lost over 30% of its value during that same time frame. Now, did it drop as much as the market? No, it didn't. But do you still want to be buying something that's going to potentially lose over 30% of its value? I'm not saying it's going to happen again. I'm saying that you look at each chart to make a determination as to where you want to put your cash. One place I like is going to be safe banks, because let's say you have Apple at 100 and Apple then loses 30% of its value, and you took out your cash at 100. Well, you now have a 30% sale. You can buy it. Your dollar is now worth that much more, assuming you can have your dollar in a safe place. The question about gold is, well, I'm expecting gold to top out over the next 18 months or so, and then enter into its own long bear market. So, you have to really understand where each asset that you're looking at, where it is in its own cycle. And you're going to have opportunities to be able to play that. I'm sure there's going to be a point within these cycles that gold is going to well outperform the market. And if we see that setup happening, then yeah, we're going to suggest our clients to go to gold. But, gold is not going to be the be all end all answer, as most people believe. It really is going to depend on where it is in its cycle. So as we go through this bear market, we're going to be looking for opportunities, whether it's emerging markets, which could have some opportunities, whether it could be at times gold, could be Bitcoin, but Bitcoin also, once it gets over 100,000, it's probably going to enter into a very long-term bear market as well. So there's no one right answer as to where you go. The one safest place is going to be cash in a safe bank. Where we take that cash and place it is going to depend on where we are in the cycle of all the different charts.
There's a few other questions coming in here about the Treasury market, right? People like to flock to U.S. Treasuries, which is supposed to be the risk-free rate for their portfolios. Does this also work for the Treasury market as well?
Absolutely. I mean, we've been calling the twists and turns in, for example, we use TLT as our main go-to, but a lot of my guys I have a number of analysts on LA Wave Trader and various other places that we're analyzing the actual different term bonds. But for TLT, we utilize TLT as our basis. And yeah, we've been catching all the different turns and twists in TLT for many, many years. The problem with treasuries is that when I look out towards 2026, 2027, treasuries look like they're setting up for a potential crash alongside with the equity market. So, yeah, but not when they're crashing alongside the equity market.
Yeah, no, that totally makes sense. Now, if you don't mind, I think there were a couple people here wondering if we could show a graph. So if it's all right with you, I went over to the Market Pinball Wizard here on Seeking Alpha, and I figured we could talk about silver. Is that all right?
Sure.
Okay, let me go ahead and pull this up real quick so everybody can get an idea.
Which chart are we pulling up?
The silver breakout. That is most recent, I believe. So just to give, let me make sure this pulls up. There we go. Can we see that?
Yep.
All right. So I think this is, maybe you just take, well, besides your victory lap on the calls that you've had this year for silver, maybe you can kind of explore what this chart is showing us right here and what it kind of means for the silver commodity market.
Okay, great. Now, if you look at the wave 2 at the bottom of the left side, it's a green 2. And you may see some comments about bitching in the trading room. You often get the most extreme sentiment at the turning points. And I kept noting to people when we were hitting those bottoms, we had the new people in the room and all bitching about, oh, silver's going to go down. It's going to keep going down. Like, no, we're bottoming here. But, you get the emotion. When people don't understand where they are in the cycle, emotion takes over. So that's why I have those little comments in there. But that little wave 2 is what we tracked in real time. And what we then had was a 1, 2, 1, 2, a series of 1s and 2s, and now we see breaking out in the heart of the third. Our alternative count was if 3173 held as resistance, then we would have had a one more leg down for that wave 2, as you could see the alt 2 at the bottom. But today, it seems that it made it very clear that we were taking out that resistance. We've got one more pivot, as you can see where we're at right now. Once we take out the high of that prior wave 1, which I think was about 33.65, I think we're going to be seeing some major catch-up moves in silver over the coming months. So once you take, I think 33.65 is the next major hurdle. Once we take out 33.65, I mean, it should be really quick to get up to the 40s. So that's where we're setting up right now. I'm still a little cautious, but the setup seems to be taking hold right now in the primary count. That's pointing us higher. And I know a lot of people will complain about primary versus alternative counts. We maintain a primary count as to what we see as the most probable path going forward. We use an alternative count to be prepared in case the market does not follow along in our primary count, in our primary path. What do we have as a contingency path? And once the market confirms the contingency path, then we have to readjust and move into the contingency plan. That's really the nature of the difference between primary and alt. Right now, the market is continually following through on the primary count. So I guess over the next week or so, we probably will get a full-fledged confirmation as to whether or not we can blow through that 33.65 region. Once we blow through that 30.65 region, I think within the next few months, we'll be in the 40s.
Now, you've got a great team of analysts working with you and covering all sorts of markets. Maybe you could touch on how they're breaking down these, projections of the wave counts with these Fibonacci ratios that I see over here, because I think that's a little something that might be a question to some people.
Well, yeah, this chart is very overwhelming for anybody who really isn't practicing Elliott wave on a regular basis. This chart will be very overwhelming. Why? Well, because when we talk about different wave degrees, when I said waves 1, 3, and 5 are the primary trend, and wave 1, 3, and 5 also break down into 5 wave structures each, and so on and so forth, you could be dealing with multiple wave degrees all at the same time. This chart shows you multiple 5-wave structures of varying degrees, all having different Fibonacci extensions and supports. So it really depends on what is the specific wave degree you're focusing on, and that also depends on the nature of the trader or investor you are. And this is something I pound into all of our new clients. You have to know yourself. Are you a day trader? Are you a swing trader? Are you an investor? What is your time frame? What is your risk profile? How nervous do you get about holding a position? There are so many factors that go into that determination. We push people to learning who they are as an investor or a trader. Are you trying to be a trader when your personality really determines you should be an investor? So that really will tell you what wave degree you should be focusing on. Some people should not be focusing on an 8-minute chart, and we utilize 8-minute charts to hone in on the current breakout that we got today. So what level trader are you? What level investor are you? What are you comfortable with? You have to know yourself, and then you can make a determination as to which one of these wave degrees should be your primary focus. So this chart will look very confusing to somebody who really does not understand Elliott wave, because we have multiple degrees on this chart. I think it was yesterday, I think it was a $1.70 or so that came down on the USO. But to be honest with you, I don't think that was enough for a wave two. So we're watching the USO to see if it can provide us with a nice setup. What I like in a nice setup is a 1-2-1-2 structure. Why? Third waves are usually the strongest waves you'll get in equities. In commodities, it's third waves, and fifth waves are even stronger than the third waves. But what you always want to be focusing on is you want to be looking for where you can enter a market during a third wave, because you're going to make the most money in the fastest amount of time. It's the best place to be focusing your money. So I always look for a 1-2 structure, because after 1-2, look, I'm an accountant. I know 3 comes after 2. So I'm looking for a 1-2 structure. But to give me even more confidence that we're about to get a real big third wave rally, we have to remember a wave 3 takes shape in 5 waves also. So once we get a bottom in a possible wave 2, I'm looking for another 5-wave structure to develop off that bottoming. And that initial 5-wave structure is going to be wave 1 of the 5-wave, wave 3. So I always look for a 1-2-1-2 structure, and that's where I like to get into a market. Amazing. That's what I'm seeking here. That's what I'm looking for here. This is just the initial 1-2 that I'm looking for. After that, I'm looking for one more 1-2.
You're looking for one more 1-2 after this one. Then you're saying, okay, let's pile.
Then it's time, right? And then you have the beauty of it is you have a setup that gives you a low risk, high probability setup. Why is it a low risk setup? Because once you get a rally off wherever that first 2 bottoms, you then get a 5-wave rally. You're then going to buy into the next pullback, which is the lower degree wave 2. You then set your stops at the first wave 2. So it gives you a very defined entry point with a defined amount of risk. And that's why I love the 1-2-1-2 structures. Defined amount of risk, lower risk, higher probability for a larger profit potential.
Now, I see some of you jumping in the chat here asking about how you can get into Avi's group here. So I went ahead and dropped the link for you. And if you're watching the replay, it'll be right beneath the video as well. So please go ahead and check that out if you're interested in joining his investing group, which, I mean, thousands and thousands of members that you built, like I said, over the last 13 years. So obviously you have the people that have been doing this with you for a long time. Incredible team of analysts that you have built over the years as well. And I wanted to see if we could jump back into one last market with you today. And I pulled this just seconds ago. I believe you just put this up. So hopefully it's not giving away too much sauce here. But the whole thing behind your service is that you're in there every day, updating constantly what you're seeing going on in the pullbacks, what you're seeing in the extensions. So maybe we can just go through this one real quick and what you're looking at with what looks like 5,500 down there.
Well, this is the thing about how we track these smaller degree waves, and everything has to fit in like a puzzle. Normally, when you complete a 5-wave structure, you normally will see a pullback. You finish off a wave 1, you normally will see a pullback that usually ranges between the most common pullback percentage is about 0.618 of the prior wave 1 rally. So I usually will have a target between 0.500 to 0.764 as my wave 2 target. And you see that as the big box in the middle. The reason I am maintaining that expectation is because if you look at the alt 1-2 on the left side, That all too only came down to less than 0.236 of the wave one rally. It is rare to see a wave two that shallow. However, because of the nature of the manner in which the market has been moving over this last year or so, it's something I have to consider at least as an alternative. So as I'm watching the market move through the current region, we utilize something called Fibonacci pinball, which forms a very objective box around the market, around the Elliott wave analysis. So it'll tell me if I'm right or wrong. So while I'm ideally looking for a larger wave two pullback, the smaller degree structure is starting to give me some indications that the alternative may actually play out. And that micro pivot that I've added on there, it tells me if the market breaks out through that pivot, it'll give us an opportunity to buy into the market, even though it's not what I expected. It tells me I was wrong about my primary expectation for a larger degree pullback, but I could still join the market for the rally we expect. So if we break out through that micro pivot, it gives me, again, a low risk, high probability opportunity to now join what could be a multi-100 point rally. And it's only approximately a 20 point amount of risk that one would accept to then join in what could be a 400 point rally. So I don't view this as saying, well, if I'm wrong, I'm screwed. No, if I'm wrong, I still have a 20 point amount of risk to take to still be able to join a 400 point rally. I would much prefer to get a buying opportunity much lower, which is what the standard expectation is, because you don't expect the standard expectation to be less than a 0.236 retracement. But should that be the actual wave count that's going to push us higher, we still have an objective framework to still get us into the rally with a very low risk setup. So that's what this is presenting right now.
Now, let me ask you this question. In regards to Elliott wave theory and how you like to approach it specifically, time series, right? I noticed a lot of these were the 5-minute charts. Is that mainly what you focus on? Do you look at daily, weekly? Does it work in those time frames as well?
As Elliott said, it is a fractal system, which means it's variably self-similar at all different degrees of trend. I'll use a 5-minute chart, 8-minute chart, a 60-minute chart, a 144-minute chart, a daily chart, a weekly chart, a monthly chart. Absolutely. We use many time frames because, look, we're approaching 9,000 total clients, and about 1,000 of them are money managers who represent God knows how many other people. No one is the same. Everybody works on different time frames. Everybody works in different ways. We cannot just do everything based on one specific perspective. We provide perspectives on all different time frames.
Amazing. And lastly, I got to ask you before we jump into some of the questions here in the chat, the markets, right? Is there any market where you don't really see Elliott wave working?
Yes, and I've written about this extensively. We understand that Elliott wave it tracks mass sentiment. So mass sentiment is displayed by, generally the size of the company. If you have a macro, a mega cap stock like Apple or Google or that represents mass sentiment. So that abides by Elliott wave analysis quite well. So clearly the S&P 500 does. But when you look at mega cap stocks, you put that on one side of the continuum. We look at the market based on a continuum. So on the right side of the continuum are these mega cap stocks. Let's go all the way to the other side of the continuum, and let's say it's a micro cap biotech stock with one item in production, with one medicine that's in production. That kind of company is not going to represent mass sentiment. That really, you have to understand the fundamentals of what they're trying to do in that biotech company for you really investing in that. So I will usually stay away from that segment of the continuum. So you have the micro cap biotech company all the way on one side, and you have mega caps on the other. An Elliott wave works on a continuum. It's a much stronger analysis methodology the further up the continuum you are.
So let me ask you this. Some of these questions coming in here through the chat. I want to make sure we get to them before we run out of time with you. Someone asked, can you ask what books you recommend or how long somebody should anticipate the learning curve being for Elliott wave theory if they were to jump into the market pinball wizard with you?
You will not pick this up in a week. You will not pick this up in 2 weeks. If you are exceptional, you probably can pick it up in a couple of months. I will tell you that it took me, now the main Bible is Frost and Prechter's The Elliott Wave Principle. That is the Bible of Elliott Wave analysis and how it works. It took me 6 reads until I was able to really be able to work with it at a real workable level. 6 reads. Now, I also have to say, at the time, there were no sites like ours, no services like ours that will work with you on teaching it to you as you're learning it on your own. There was nobody to support you during the times when I was learning it. We built our services based around being able to support people in learning how to do this. So really depends. I mean, I've had the analysts that all the analysts that I hired from an Elliott Wave perspective, I've hired them because they've learned from me and I've seen their work through the years. And as they get good enough, that's when I'll hire somebody. Not everybody gets to that level, clearly. I'm a very picky hirer. I'm very picky. But the problem is some of them really learned it fast. Some of them took more time. Everybody is different in how they learn. But before you even pick up the book, The Elliott Wave Principle, I strongly recommend a book called The Socioeconomic Theory of Finance, written by Robert Prechter. It is a 600-page book. The first 2 chapters alone are worth the price of the book. It will open your eyes to market dynamics. It will clear away all these fallacies that everybody believes in about gold is a safe haven and you know things, and it gives you empirical evidence to support his perspective on how markets really work. It is probably the most brilliant book about how markets work that I've ever read in my life, and I suggest it to every single person who wants to really have their eyes open. You know, you guys have seen The Matrix, right? The red pill or the blue pill. You know, I'm telling you right now, you know, if you really want to understand The Matrix, read this book. It's called The Socioeconomic Theory of Finance. But I'm going to warn you, you're never going to be able to see the market again the same way. So make sure you really want to take that pill like Neo, what was it, Morpheus warned Neo. You sure you want to do this? So I'm just telling you, it will give you an entirely new perspective on how markets work, and it will blow your mind.
Sounds
so
like
those are the 2 places to look.
A sip from the Holy Grail, right? So something that you've done over a decade ago. I mean, you've been at this for such a long time.
I've been at this for decades. I only opened up Elliott Wave Trader 13 years ago, but I've been doing this for decades.
Now, let's talk about, I mean, over these last decades, the market has shifted into different cycles and different feels. And right now, there's a question where I'm going with this is, we see the basket of the S&P 500, right, is dominated by just a few stocks. So are those 7 stocks, those 8 stocks, maybe 10 stocks that are in these like $1 trillion going in and out and all the tech names, is that something that you really focus on to also just add as an input, or is that just noise to you?
Well, we have a whole team called Stock Waves. We have a team of Elliotticians. I think we have about 5 or 6 analysts in that team, and what their job is to analyze. They literally are analyzing hundreds, if not even thousands, of stocks by now. I mean, these guys are, the amount of work they put out on this analysis blows me away. But we analyze all different stocks throughout all the equity market in the United States. And yes, we look at that to see, you know, how does that line up with where we are seeing the S&P 500? In fact, Zach Manis and Garrett Patton actually do once a month, they will do a sector analysis and see how the various sectors, the major sectors, along with the big stocks within those sectors, how that aligns within the overall S&P 500 structure. So yeah, we absolutely take all of that into account.
Amazing. I just had a quick request come in. Can you please restate the books that you mentioned? People didn't catch it real fast.
The 600-page theoretical book is The Socioeconomic Theory of Finance, written by Robert Prechter. And it will take you through some he breaks down markets better than anybody I've ever seen, with empirical evidence outlining why and how fundamentals work relative to how sentiment works. And it is an amazing book. It is an absolute eye-opener. And then the other book, once you're done with that, the other book is the Elliott Wave Principle, written by Frost and Prechter. And that is the Bible of how Elliott Wave works. That's the practical application of Elliott Wave. The first book is the theoretical underpinnings.
Amazing. Thank you for that. So this question is a great question to ask you. I was going to ask you anyways, but since it's here, I'll just read it verbatim. When someone that's a novice signs up for your service, what are they getting and what should they expect?
Well, the first thing I tell people is I don't want them to do a damn bit of trading or putting any money into the market until they understand what we're doing. People come in, they get excited, they see people making money, and they just want to join in. I'm going to tell you, I wrote an opening letter to people, and I strongly advise you to follow the advice in that opening letter. I've been doing this for decades, guys. I've been teaching people. We've taught thousands of people in these last 13 years. We know what we're doing, and when we tell you, take your time and actually focus on and learning what we're doing before you start putting any money to trying to follow what we're doing. So you expect to spend your first weeks, if not a couple months, learning. We're going to teach you how to look at the market in a very, very different and objective way. We take out bias. I don't want to know any fundamental stories. I don't want to know any of that. Why? Because oddly enough, fundamental stories will cloud your objectivity in looking at the market how it is. If you buy into a story, if you fall in love with a story about a stock, chances are you are not going to be able to look at objectively how that stock is moving from a price standpoint. So we tell you, and I have this, this Yoda meme that I love to put out. And it's when Yoda said, "You must unlearn what you have learned." We are going to teach you an entirely new perspective about how markets work. It's not for everybody. People may not like it. I get that. We're not going to be for everybody, but I can tell you that every single person that has taken me up on my suggestions and advice about how to employ Elliott Wave into your toolbox, I have never had somebody who's put a huge amount of effort to it and come back to me and say, you were wrong. I'm telling you, almost 9,000 clients, I haven't had anybody who really put effort into it and came back to me and said, you're wrong. The only ones that will usually leave us are those that, I respect that. If you don't want to learn something new, I respect that. But just be honest with yourself. And that is probably the most important thing I could tell to every single investor. Whether you work with us or not work with us, the most important thing you can do is be honest with yourself. Be honest with yourself about how you're looking at the market. Be honest with yourself about whether or not you should stick into a stock or not. Have you fallen into the most dangerous four-letter word in the stock market, and that is hope? Don't go into a stock hoping. You really have to understand where you are in the bigger degree of the trend, of where you are in the cycle. If you're willing to learn, we are willing to teach.
That's a great message. I really like that. We need to touch on this because obviously Seeking Alpha has an audience that's worldwide, and we have lots of people in different markets from Canada to Europe and beyond. So Elliott Wave theory, does that work in global markets as well, or do we just mainly should focus on it with the US markets?
Well, we actually have a world market service. So our analyst is actually handling, I think it's maybe 15 different markets of the largest markets worldwide. So yeah, remember, it works with anything that displays mass sentiment. So if you have mass sentiment being displayed, which stock markets are the purest form of mass sentiment, then yeah, it works quite successfully.
Is there a certain threshold for that sentiment, though? Is it a certain number of volume of shares traded? Is there any kind of metric like that?
Again, it goes back to the continuum. The higher up the continuum you go towards those mega caps, the stronger of an Elliott wave analysis and reliability and probability you will get. The further down the spectrum you go, the less reliable it is, because it really has to be displaying mass sentiment.
Amazing. All right, Avi. So we're about out of time here. I don't want to waste any more time. I see some people having to sign off as well. But I did want to drop here in the chat. And again, I'll link it below the video, not only the link to your service, but also I just put in the replay from your session when you did the Seeking Alpha Investing Summit back in June in New York. We loved having you there. It was an extremely great session.
Thank
so
you.
everybody watching, if you want to learn more from Avi, go watch that right after this, or put it in a playlist, stick it away for later. Avi, is there anything else you want to say before we jump off here? This has been extremely valuable. I can't thank you enough.
I thank you guys for having me. But, again, I think if you could walk away with anything from me, do not believe everything you read or hear about how markets work. There are so many fallacies that are fed to the public. The talking heads will just talk just to take up time so they could sell commercials. Please look at markets in the most honest way you possibly can. Look at empirical evidence. Don't assume that something somebody says to you is right. Seek out the empirical evidence. Seek out the truth of how markets work. And most importantly, be honest with yourself.
That's a great message. And seek alpha, right? Just to plug it.
Seek alpha. Absolutely.
Alpha. All right, everyone. Thank you so much for taking the time to watch this today. Or if you're watching the replay, we're really glad that you joined us here as well. As mentioned, check out the Market Pinball Wizard here on Seeking Alpha. Jump into the community. Thousands of people. It's been around for a long time with great success. And Avi, hopefully we'll get to talk to you soon, and we'll see where this market goes from here.